You're listening to Payments Innovation, a podcast dedicated to helping business leaders navigate today's global digital economy. Looking to learn about the latest innovations within fintech and payments? You've come to the right place. Let's get into the show.
All right, welcome to the episode of the Payments Innovation Podcast, brought to you by Currency Cloud. This is your host, Chris D'Antuono, and as you can tell from our viewers today, there is a new twist that we're bringing in video recording, and so we're really excited about a simulcast opportunity to have video as well as the audio streaming as our traditional podcasts have been the last few years. So really excited about our transition into exploring more deeper dive. My focus moving forward is going to be on the challenger bank sector, which we've released a previous video to explain exactly what we're looking at, more thought leadership opportunities within the challenger bank space here in North America. More specifically in the US, there's a lot more complexities there, which I'm sure we'll address today. But as we get into it today, I wanted to introduce my guest, Ben Soppitt from Unifimoney. Ben has founded Unifimoney and has recently gone into a beta test launch with his users. And instead of me explaining his value proposition, I'll go ahead and kick it over to Ben. Ben, welcome to the show.
Thanks very much. Great to be here.
Yeah, it's really good to have you on. And Ben and I have been in conversations over the last 6 to 10 months, I think now, working and just discussing the space in specific. And I really wanted to get him on to kick off our new series. He's really done a lot of research using the help of everybody, I think, as well as himself, to understand really the landscape of the market here in the US. So Ben, if you could just give a background for our listeners, and then what you guys are doing at Unifi, which is a bit different, I think, in the market, and then what your plans are a bit moving forward.
Absolutely, yeah, thank you. So we consider ourselves the first fully featured neobank focused on serving the needs of young professionals. So these are high-earning young professionals, affluent millennials. We're really focused on enabling financial services to be easy, to deliver genuine value for money, and to enable people to reach financial resilience, financial security faster and with a higher probability of success than if they conducted or managed their finances through traditional means. So one of the things we noticed was that, or realized, was that the vast majority of the sins committed in personal finance by mass affluent consumers tend to be sins of omission rather than commission. It's what they don't do that hurts them. They don't dollar cost average. They don't maximize their deposit interest. So, for example, an average customer earning over $160,000 a year in the US has $42,000 sitting in a checking account earning next to no interest. And then, $16 billion left in unredeemed credit and debit card rewards. And whilst these are small in the greater scheme of things on a day, a week, or a monthly basis, they add up. And they add up potentially to a great deal of money over the working life of a person, and the opportunity cost as well. If that money was properly invested in a low cost, highly diversified fund, it compounds. So the reason why people don't optimally manage their money is because it's really hard. We exist in a very challenging landscape from a financial services point of view, where products are very fragmented. There's a huge amount of friction in moving money. The amount of work involved for the individual benefit on a day, week, month basis is very low. And it's managing money is a low interest category for most people. Earning money, everyone's interested in. Spending money, great fun. Managing money, not so much. So people are not good at doing high frequency, low interest, complex tasks. But technology is incredibly well suited to that. So what we want to do is create a platform that integrates traditionally separate products such as checking, savings, credit card, investing in a single app. And secondly, automating, genuine automation of the tasks that we should all be doing on a daily basis: saving, spending, investing. We should be saving and investing as often as we're spending, but we don't. But you can do with the use of technology. And when I say genuine automation, I think the word automation, money management automation is overused in the market. In most times, what that means is automated notifications telling you what to do. Right. And whilst that's slightly better than not doing anything at all, the real benefit, I think, is only going to be realized when technology actually does it for us, as opposed to telling us what we should be doing.
Right. Yeah, taking action of the actual money movement or decisions.
Yeah. So the difference is being told you've got too much money here or you should be doing something there. Again, that becomes a nag very quickly. It becomes this background noise. Whereas, and I think Acorns really created this. They really took this idea of do an action once, and then as long as you do nothing else, you continue to do the right behavior, to model the right behavior with zero effort. So we've really taken that idea of technology doing what you should be doing for you with your money management, and we've extrapolated that and expanded that across all of everyday money management, saving, spending, and investing.
Yeah, and to be honest, I'm guilty of the alerts, and I do get them. I tend to get them frequently, and then basically it goes to more of an ignore because essentially it's the same alert pretty much at the same time, right? So,
exactly.
If you can turn that into action, it would be beneficial in that aspect.
Yeah. So the better outcome for all of us is we tell you when we've done it, and we tell you how you're benefiting. Exactly. Not we tell you what you've done wrong and what you should have done. And there's a lot of psychology involved here, and I think that's where a lot of fintech founders tend to focus on the technology, and they tend to focus on optimizing for rational behavior, whereas we're all guilty of irrationality, and we can solve for that by the judicious use of technology to essentially help trick ourselves into modeling behavior that benefit ourselves.
Makes a lot of sense. So I guess to take a step into the ecosystem, and I know we've talked prior to this, and I think it'll be a good topic to start on. Whereas the ecosystem, maybe about 5 years ago, maybe even more than that, it was really about debundling the banks, right? So taking a specific service and offering that service out. For example, as you mentioned, Acorns, right? Taking an investment type of model, i.e. they did it differently than the banks were maybe doing it at the time, but that was the fintech offering. And now we're starting to see companies like that start to rebundle other services, whether that's a checking account, a type of savings account, or how you will, tied to a cart. Could you talk a little bit about, I guess, the transition from doing that, why you think that's happening, and then the benefits to that? And I guess probably the challenges that go within that as well.
So there's an irony in that, with the last 10 years with fintech doing exactly that, taking a niche element of the overall ecosystem and optimizing for it, is that it's actually led to greater complexity. 20 years ago, it would be unusual to have more than one or two banking relationships, and you bought everything from that bank. Whereas now, it's not unusual to have 10 or 15 different financial apps on your phone. And you don't use 80 to 90% of them, or you don't use them very regularly, but they're still there, and you've invested time and energy. So it's actually become almost harder to manage your finance, even though individual elements may be optimized. And it's a truism, I think, that for consumers, money is a very holistic thing. Our money, whether it's invested in your house, in your wallet, in cash in a piggy bank, whatever it might be, is seen to be a very singular entity. Whereas the industry treats it very, very separate. Your insurance, your investments, your 401k, your income, your savings, your deposits, your CDs. It's a very industry-centric model. And I was guilty of this. My first idea was essentially Brex for consumers, because I came from the credit card industry, and it was a real eye opener. I had a meeting at Brex and listened to Enrique talk about what his journey. Never occurred to me that a small fintech could actually bring innovation in the credit card market. I'd spent a significant portion of my career trying to convince big incumbent banks to be innovative, and of course failed. And so this opened up this huge possibility that all of this sort of latent ideas about innovation around credit cards could maybe be put into action. But I felt that it really wasn't going far enough. Solving for credit cards, but not everything else, is a bit like a doctor fixing your feet, but not your hands. You want all of these things to be working optimally. And that's really was the genesis of this idea, which is that, well, what if we put all these things in one place and manage them as a holistic whole? And it also gave us the ability to focus, I think, on, and it's going back to this idea that a lot of founders are focused on the engineering and rather than the psychology. It's my belief that most consumers are more focused on the outcome than the process. They're not that interested in the APYs and the APRs, or the difference between that, the product constructs. And they all know, and I think it's relatively universal, that everybody wants to be financially resilient. Everybody wants to feel that they are managing their money properly, and they're getting the most money back from their own investments. And it's patently not the case in the current market. And the industry has done a really good job of hiding that. And part of our job is to try and help people to see and understand where they are losing money, whether it's a hidden cost or a real or an explicit cost. Nobody, the sense of taking money out of your wallet physically is a very visceral experience for people. But if you take the same or more money out, but it's done invisibly in hidden, opportunity cost being the classic one. It's very difficult for people to get their heads around opportunity cost. So by rebundling, it really gave us the opportunity to talk to people about the outcomes, and not to have to explain, or not to have to expect them to actually do a myriad of activities that they're very unlikely to do on a sustained basis. So I think that's, this rebundling, but in a very distinctly fintech environment, I think is really interesting, because it gives it. The problem with the old model is that one company can't be good at everything, and yet banks were developing everything in house. It was all on top of legacy infrastructure. Whereas a modern fintech rebundling can be taking the best in the market and integrating that into a singular customer experience. So it should mean, hypothetically, there's obviously the technical complexity and the complexity of managing across multiple regulatory and compliance regimes is hard, but not impossible to solve for. And if it means we can bring the best technology, the best products and services, and rebundle that for specific consumer segments, that's really what we see as the future. And the market is slowly moving there. You mentioned Wealthfront, Betterment, etc., Robinhood adding on products. What we've done is really jump to what we think is the end game, which is a fully integrated platform, and genuine integration, where the products actually are not just sitting alongside each other, but dynamically linked and dependent upon each other.
Yeah, so there's one point in there I want to dive into, and I do want to get to the segmentation part, because that's a big piece, I think, of where you guys differentiate to the market. But you did mention, so, the consumer, let's say 10 years ago, did have all of these services at the bank, but apparently there was opportunity for fintechs to, come in and take pieces away from that, and then now rebundle. Do you run into the same situation now for the consumer? Now they get, I'm sure, a better user experience through the technology and through the user experience from the application, but are each area is being focused on enough? So let's say you got like a Wealthfront, a Betterment, for example, or traditionally investment type of products. Are they giving enough value to the checking side of their business, or different segments within that to sustain that consumer? Are you going? Is there opportunity for them to run into the same issues that the banks had with the end consumer of not giving them enough, services?
I think there's been a big shift, obviously, during COVID, and with the Fed effective rate falling to the level it is. I think a lot of the ideas around cash accounts that Wealthfront, Betterment, M1, etc. have launched have probably lost a lot of their reasons for being, in that they were really running with a high interest story, which was easily achievable when the Fed effective rate was over 2%. You simply had to keep your costs low and give a significant amount back. And the big banks the big banks haven't actually changed their checking and savings rates during COVID. They didn't have to. They were already 0.01%
Exactly.
and 0.02% respectively. Whereas if you look at the last 10 years and how the Fed effective rate has varied, it's been extremely high, and it's averaged like over 1.5, or something like that. Whereas the banks have just been giving nothing back. They've just been absorbing that as profitability. And that was a clear opportunity of arbitrage, just to give more back to consumers because you could. And that's disappeared. So now the question is, well, if we can't simply offer more money, what are we going to offer? And I don't have any insight into where those companies are thinking, but fortunately, we were actually thinking both in terms of value and in terms of product proposition. And the product proposition was genuine automation, so that the manual labor was taken care of. We take care of the manual labor, and we help guarantee a better outcome because of that. So it's a bit like the value of dollar cost averaging is not trying to time the market, and you're going to be wrong at least 50% of the time. It's about being in as early as possible at the lowest cost as possible, and enabling that, as Acorns did originally, and now we've extrapolated that, is I think a really great product innovation that is independent of things like the Fed effective rate and short or medium term pricing changes in the market. It's just good behavior that we should all be doing. None of us do, because we've got better things to do with our time, and we've got more demanding, more interesting things than the manual work involved in, let's say, investing $3.50 a day for 30 or 40 years is a very high amount of manual labor, and not many people are going to be able to sustain that over even a weeks or months, let alone decades. Whereas technology can do that for you. And if you were to start doing that from age 26, by age 60, you'd have over $200,000 in a portfolio. And so that it's a no-brainer as long as it's no effort, and that's really what the product innovation is. So I think that's certainly where we think that there is as much value in the product innovation as in the pricing. Pricing goes up and down, and there's things outside of our control. Whereas product innovation, if it's solving for intrinsic structural issues around people's behavior and mindset and money, then that should be evergreen value.
Yeah, and like you mentioned, I mean, the automation of the passive opportunities is monumental if you look at it over a genuine period of time. One last piece in this area, which I'd want to cover before we transition to the segmentation side, is that by rebundling, it does require, if you want to offer a full suite of services, it does require the financial institution or their partners to be able to have some sort of API infrastructure as a standard BAU moving forward. Especially in the US, it is fairly new, and you're not going to have that many banks that have that opportunity. So how, I guess, are you guys, or how have you navigated the ecosystem here to be able to package together different services to be able to bundle and really sell it as your own value to the end customer? I mean, obviously, you don't have to give away your secret sauce and all of that, yeah. But we're totally behind presenting API infrastructure comparable to making many partners that you pass in customers over to. And I think it's a key point that we should touch on before we transition to the segmentation side.
So there's two challenges. One is the technology readiness, and the second, which is little talked about because it's not very sexy, and there's no one comes out of university with a degree in process and regulatory optimization, but trying to work across 3 or 4 different regulatory environments and have a systematic funds flow that makes sense for everybody across those. And we're not just talking about the checking account and the investing and the credit card, but international remittance, for example. What's the funds flow look like? What is the compliance, KYC, AML account setup process look like? Other forms of alternative investing trading, so gold and silver, for example. Again, you need to create an account. There needs to be, what's the model for the funds flow? That to be honest, is more of an art than a science. And we're finding that because what we're doing is not been done before, no one's got experience there. So we're all working with our partners. And I'd say we're working with 7 or 8 different companies at the moment, from very large, very traditional, like UMB, 108 years old, $26 billion in assets, publicly listed, all the way down to API first tech startups. And the tech is different, but it can all be solved for. The really hard part, I would say, that we're doing for the first time is trying to figure out what does opening a single account look like from a customer's perspective, and how do we orchestrate that across 8 different partners who have fundamentally different compliance, regulatory ideas, processes, systems, providers. And compliance and regulation is an art. It's not a science. You'd think there'd be 10 things you need to satisfy regulation, even if it's the same regulator. But there's a huge amount of customization. There's a huge amount of subjectivity involved. And it means you have to talk to the individual compliance heads of those companies and rationalize with them and get their agreement. And honestly, the tech side is pretty straightforward. And there's a lot of people out there who know how to build really good APIs. There's very few people who've done this work about trying to orchestrate across multiple different regimes. And it's complex and hard. So I'd say, honestly, I know anything in technology can be solved for, and we're in the right place to solve for that. It's the old-fashioned negotiation around how do we create the right experience whilst maintaining absolutely the right levels of compliance, risk management, and adhere to the spirit and the word of the regulation.
Yeah, it's a really good point, and I think there's, we're at the beginning of the infrastructure play, I think, and that's where open banking comes involved, where you would hope that there's some sort of open compliance regime that helps you utilize multiple tools in a compliant manner and give you that.
Compliance if compliance as a service, providing it's cross industry, so it's not just insurance, it's not just banking, it's not just payments, it's everything. The first person who comes up with that idea, I'm all behind them. I'll be their first.
Yeah, it's definitely opportunity in that space. So I did want to transition over to the segmentation side, which we've been dancing around to this point. But I think where you guys are at and who you're targeting is definitely a differentiator in the market from comparable challenger banks or programs. I think the incumbents to start, I guess you can call like the Simple Financials, Varos, and Chimes of the world, very specific segment to take away from the banks. You would think maybe underbanked, a little bit more of a lower income aspect of a user to take away from the bank. But I think to the bank's perspective, you're not really even taking a fraction of a cost to them or of a benefit. So I would love to get your thoughts on, I guess, where we're going as a landscape of the challenger banks, moving more into segmentation, and then specifically you and your team and what your value that you're bringing to a specific segment as well. It's really interesting, in your take on it.
Yeah, so there's 2 reasons why we focused on affluent professionals. The first is the competitive pressure. There's no fintechs in that space. Of the 130, 140 players in fintech banking services, over 95% of them are focused very clearly on people earning less than $25,000 or $50,000. It's the typical debit card, salary advance, mobile app model. And then there's a few who are around the sort of 50 to 100. And our focus is 100, 150,000 plus. And we wanted to compete with the top 10 banks. We did not want to compete with 75, 85 challenger fintechs, with essentially the same product aimed at essentially the same people. Secondly, we also saw those customers as being incredibly underserved and by the incumbents. And yes, there's a lot of choice. You can go and buy the same product from Chase, or you could buy it from Bank of America, but it's effectively the same product, and you're getting gouged whichever way you look at it. And we fundamentally believe that affluent, highly paid individuals need just as much, if not more, help than those who are not earning as much. If you look at we tend to talk about young doctors as a sort of as a persona. It's more difficult to get people to feel sorry for young bankers or young lawyers. So let's take young doctors as being a very a sort of a group that most people would like to see successful. Young doctors actually suffer, or doctors in general actually suffer. They're amongst it's in fact that it's the highest earning profession in the US. Something like 4 or 5 of the top 10 highest earning professions in the US are all to do with medicine and dentistry. And yet, a very high proportion of those people do not retire by any means wealthy, and in many cases, quite the opposite. And the reasons are fairly well documented. There's a really good blog called The White Coat Investor. It talks a lot about this. Young doctors are coming into the workforce 10 years later than anybody else. They're coming in with, on average, $200,000 of student debt. They are working they go from zero, they go from student level economics to relatively high earners relatively quickly, and no one's there to give them training or support. Plus, they have very demanding careers, which is taking up the majority of their time. So the last thing they want to do is figure out how to manage money and how to optimize, and then they're entering the workforce in their late 20s, early 30s, which is statistically the moment that the majority of people in the US get married, have kids, and buy a house. So there's all of this stuff happening all at the same time, and decisions that are made at that point can affect them for the rest of their life. And that's exactly the time when they need more help. So we saw a genuine need in the market. We saw the incumbents really benefiting from lack of competition, lack of real choice, lack of innovation. And we didn't see any other fintechs really focusing in the way we want to focus on this market with a fully featured value proposition that gives you everything and more that you get from a top 10 bank, but a whole bunch of things besides. So that's really where we ended up with that audience. It's sort of ironic. We do talk to investors. We had one investor who's a millionaire living in Dubai said, "I'm not going to invest in you guys because I don't think you're inclusive enough," which seemed a bit odd. And there's a lot of VCs out there who are very keen to invest in subprime mass market consumers because the need is apparently much more obvious. I would argue that the need is just as great for high earners. Being a high earner does not guarantee being rich by any stretch of the imagination. And I think COVID has really taught an entire generation that bad things happen to good people. Nobody at Uber or Airbnb was expecting to be laid off. And financial resilience is, I think, incredibly important, both on an individual and at an economic level. It's the mass affluent who are paying the most taxes. It's the mass affluent who are buying the most houses. They are the ones shopping in the grocery stores. They're the ones going on holiday and really powering a very significant part of the economy. And the more of those people that are financially resilient, the less money. We calculated around $400 billion is going to the banks as profit that should and could be going into consumers' pockets. That's if you look at that over 10 years, that's a huge amount of money that should be going directly into the economy, but is actually going directly to banks, shareholders, and senior management. And we just, we think that's unfair. We think that society is better the more money is going back to consumers, and the more financially resilient people are in society, then society will benefit. It means things like COVID happen. More people will not be in a position to rely on state aid. More people will be able to rely and survive and thrive in those situations. But we can't do that and keep the big banks with the degree of profitability that they've grown very accustomed to, and treat as their natural right. They're under no pressure to give that money back to consumers. The only way that's going to happen is through competition.
And so that brings up a good point. What does that mean for them? Obviously, when you become successful with attracting that generational consumer that you're looking for, what obviously it'll cause attention once they start seeing less of that profit that you see, even though the profit's pretty insane. What does it mean for them? Do you see them? Well, I mean, obviously, go ahead.
The banks have no economic incentive to change in the current environment. You're not going to be becoming the next EVP at Chase if you suggested increasing the checking account from 0.01 to 0.1%. That's just giving money back to consumers for no reason. They're not going to have more accounts that way. There's this very strange dynamic, and it was really well synthesized by a piece of research that we read recently, and it was a quote from a bank CEO, and he said, "You need to torture people pretty hard before they leave a bank." And I think that's really, it's odd, and it shouldn't be that way, but it's reality. There's this sort of Stockholm syndrome that consumers remain with banks despite the evidence that banks are not working in their best interest. And up to this point, there's been no alternative. So the banks haven't had to sweat at all. If you're got a checking account, you're a high earning young professional, you've got a checking account with Bank of America, you've got your Chase Sapphire Reserve, you've got Robinhood for, play investing. You're not going to go and bank with Revolut. That's not challenging Chase and right. B of A's hegemony at all. We need companies like ours that are genuinely providing an alternative, genuinely differentiating both in terms of product design and value for money. And it's only that when we collectively get up to scale that the economic interest of the big banks is going to change. And suddenly they will at some point have an economic interest in changing. And it's only then that we're going to see change. And it's not because bankers are evil people. It's just they're existing in a company and they've got, families and lives and careers. And you become successful in a bank by keeping it going. Until the external pressures force them to change, there is simply no reason for them to change. And then sadly, in the current environment, that's what we're faced with. So I hope that and it's not just going to be us, it's going to be a whole cohort of new players that are going to begin to erode the complete lack of real competition that the big banks are under. And it's really the top 6, top 8 banks. 83% of all deposits in the US are with them. The number of banks in the US has gone down, I think, in the last 10 years from 12,000 FDIC member banks to less than 5,000 today, and that's going to continue. And all that money, bizarrely, despite the fact that the big banks are providing the least value for money, it's all going into the big banks, and there needs to be an alternative.
Yeah, and I think it's a smart move by the UMBs of the world, the sponsor banks, to be able to transition into this type of model for them to get a piece of those deposits that probably traditionally they wouldn't get whatsoever. So attaching themselves to someone like you guys to be able to attract the deposits for themselves to be able to operate and compete.
I hope so, yeah. And I think Goldman Sachs is a really interesting.
Very interesting. That was my next topic here.
Yeah, they don't have any of the incumbents, economic self-interest. That they're not in. They haven't been historically in retail banking. They started, with Marcus, etc. They bought a wealth company recently, a wealth management company recently. They've got all the resources in the world. Now they're still slow, and they have all those issues of being a big incumbent. But I think the wild card really is going to be Goldman Sachs plus a collection of fintechs that are going to collectively create the pressure on big banks to actually move. And it's going to take 5 to 10 years.
Of course, and I do like the way they're looking at it. As I touched on earlier, they're really offering more of a. They do have the retail side, and they're going to package that together. But they are offering, that banking as a service layer as well, partnering with Amazon for loans and just different opportunities to plug in where they see fit to be able to operate and kind of expand that ecosystem to allow a lot of their services to embed into other apps as we now move towards sort of like an embedded finance type of model, non-traditional. Finance institutions be able to offer those types of services.
And I'd love to be a fly on the wall because they have so many opportunities to genuinely disrupt financial services. It's which ones do they pick and what order of priority do they put them in, and can they manage 5, 6, 7 different programs all in parallel? Right. It's going to be that's certainly a company I think is absolutely fascinating in this space. and watch with interest.
Definitely. Last piece before we close out here. Obviously, you entering the market did a lot of research on your side of the segmentation that you wanted to attract and the opportunity. Is there anything you can share with other segments that might be up for the taking that you saw doing your landscape and research that you see that there's definitely opportunity for maybe some listeners that are kind of on the fence of where to put their efforts into?
Well, I think we hit on one. Compliance as a service is definitely the big missing, a big element that's missing. And I know there are players in this space, and we're talking to some of them. I think credit cards is another wildly untapped opportunity in the market. That market really has not changed in 30 years, either from a infrastructure perspective or how the value proposition actually being offered to consumers. It's very hard work. It's very manual. It's very costly, and it's not predicated on driving innovation and diversification in terms of value prop innovation. And I think we'll see that begin to change. And we're already aligned with one company around this idea of an AWS for credit cards, where a fintech can come with very limited resources but lots of ideas and work with a platform to set up a credit card proposition in months and at low cost, to test those propositions and see, really understand consumer feedback and get the data. That I think is the nearer term big opportunity in the market. US is one of the biggest credit markets in the world, $4 trillion spent on credit. 4 or 5 companies control the vast majority of that, all with products that look remarkably similar. And it's a market that we certainly think is absolutely ripe for disruption and bringing good, solid digital thinking, shared services, shared infrastructure, take the cost out, take the complexity out, manage the risk. That could transform really, really quickly. So that's an area I think we're going to see a lot of activity over the next 12 months.
Yeah, I think so too. I think you hit both of them on the head, especially the conversations that we're having. There's at least, quite a few people thinking about it, which is a good step in the direction, which is beneficial to everybody that's in the industry. So, really excited to stay at the forefront of that.
There's an odd one that we've come across, which is precious metal trading. If you look at crypto, it's become sort of front of mind given COVID, and a lot of people are rushing to gold and these types of assets. Traditionally, gold is a very, the consumers who are trading gold are in their 60s and 70s. It's not a young person's game, but it's curiously still, interesting and sort of fun. You see people, the incredible digitalization of crypto. And then you look at gold and silver and platinum and other precious metals, and it's still, you'd think it's 1982. And I think alternative assets in general, whether it's Yield Street or Rally Road, fractional farm ownership, I think there's a lot of really interesting stuff that's going to happen around that. But I think, gold and silver is an extremely established, extremely old-fashioned business. We're talking to a couple of different companies in that field. I think you're going to see that Revolut's just announced precious metal trading in Europe. I think you're going to see younger millennials dipping their toes into precious metal trading once it's more available through mobile in particular.
Very interesting. Yeah, definitely would like to keep an eye on that for sure.
A couple of Krugerrands in the back drawer. One never knows.
Well, Ben, it was great to have you on. What I'll do is once we release this episode, we'll share your information to send prospective users your way. And I appreciate you coming on and sharing some insight from your knowledge, and really looking forward to seeing you guys grow. And good luck with your launch moving forward.
Thanks so much. It's been great talking.
Currency Cloud is an online payments company that makes international money transfers fast and simple for businesses. We're building a borderless future where international transactions are seamless for a better user experience. Discover the world's most trusted payment platform and our toolkit of developer-friendly APIs at currencycloud.com.
You've been listening to the Payments Innovation Podcast. To ensure that you never miss an episode, subscribe now in iTunes or your favorite podcast player. Thanks for listening. Until next time.